Welcome back. We're discussing the economic pressures facing Dubai and the Gulf region in general. With us is Nasser bin Ghaith, an expert in international economics from Dubai, from where he joins us. From Bahrain, we have Christopher Davidson, who teaches international affairs at the University of Durham and is author of Dubai, The Vulnerability of Success. And he's joining us from Bahrain today. And Tariq Youssef is the Dean of the Dubai School of Government, and he's here in Washington, D.C. with me. If I can bring in Dr. Davidson here from Bahrain, what is your worst case scenario? What do you think is the worst thing that could happen?
The worst case scenario is investor confidence continues to decline in Dubai. The bailout won't be enough. Investors around the world will continue to steer clear of Dubai. They will see it as a bubble going down. This has been exacerbated by some of the decisions taken in the last few weeks, notably a decision to protect the jobs of Emiratis in Dubai. This means that foreign businesses operating in Dubai can no longer fire Emiratis from their workforce, or rather make them redundant. In all boom-bust cycles, a company needs to have the ability to make redundancies, to downsize, to streamline, to stay lean and mean, and so on. This will really send out a wrong signal from Dubai, which should really be continuing along the lines of being a free port with complete economic liberalisation.
Dr. Davidson, a question here by email, if I may, to you. It came in from Qatar, from Doha, and Jenny Brashears Lamar says, Qatar will come through the recession virtually unscathed. And I wonder to what extent you feel neighbouring nations, Bahrain, for example, where you are, and Qatar, other nations nearby, how vulnerable are they, do you feel, to the current situation?
Yes, I think Qatar and Abu Dhabi are in particularly good position. They have fairly substantial sovereign wealth funds, hydrocarbon resources. They can cushion any post-oil sectors of the economy, such as real estate and tourism and financial zones that they've tried to build up in the last few years. Dubai has really been operating a model without a cushion behind it. It's built up a mountain of debt. That's not necessarily a bad thing, but as my colleagues have mentioned tonight, when a world recession hits, we quickly realise who's actually bluffing and who's not. It seems that Dubai has now run out of steam and has nowhere to go but further down the road for its bailout. Dubai, of course, has taken on debt in the past to build up its physical infrastructure, dredge the creek, build up an airline. Nothing wrong in doing that at all, but they've been building up Dubai's position as an entrepot trading hub rather than as one of these moon-based economies on the edge of a desert, which is trying to bring in foreign investment to it.
Well, let me put this this question from our chat room to Dr. Nasser bin Ghaith. This came in from our live station chat room, sir, that's running right now as we go live. It says, if Dubai is so dependent on foreign investment, won't they suffer regardless if the rest of the world loses money and thus cannot invest in Dubai? What other option does it have for alternate investment, save for the nation, except for the nation investing in itself?
I'm not saying that Dubai shouldn't depend on foreign investment. What I just said is they shouldn't heavily depend on foreign investment at this scale, and especially that most of this investment is going into real estate. That's the mistake I think Dubai has made, and I think the only way for Dubai, this real estate boom has come to an end. Everybody knows that. If it recovers, it will take years to recover. Well, Japan's story is not long ago, is still present in our minds. The only way for Dubai is to go back to its previous model, 2003, before 2003 model, and I think it still have the advantage over other competitors such as Doha or Riyadh or any other city in the region. Dubai have established itself, as I just mentioned. Dubai has become a trademark or doing business internationally. It has created a diversified culture, a diversified economy, and I don't think that this would just go away. This correction real estate sector will take away this advantage.
Okay, we've got Australia on the line. Sydney on the line here with Jeff. Thanks for your question, Jeff. Go ahead.
Yeah, I'm in Sydney, Australia. Live here, and I've been there in last October, a one-day tour.
Right.
And they took me somewhere to show me the unit in somewhere. I don't remember the name. And I find the prices which they were asking for 65 square meter of the unit, about $1.1 $1 million. That's ridiculous price. I couldn't. I said no. And I asked them for $1.1 million, what I'm getting as a dividend or as a return.
Okay. Well, this is actually, Jeff, let me put this actually to Dr. Tariq Yusuf, who's here with me. Is it that, I mean, it's true, everyone got very excited about the property and money flooded in basically into the real estate market there. Again, could it be that because it was such a young market for Dubai, that it wasn't perhaps regulated enough and people had this kind of experience where suddenly they were looking at incredibly high prices?
Well, I think you touched on it, Riz. This market was not regulated. People were hungry, not just international investors, I would add, as we keep on repeating throughout the show, but regional investors from Iran, from Saudi Arabia, from Qatar and elsewhere. The limited investment opportunities in the region, together with high oil prices, meant that as soon as a sector was opened up for foreigners to own, buy and sell, and this sector happened to be real estate in this case, this sector just boomed, ballooned. And it was only a matter of time, absent even the global correction, that there will be a substantial price correction in the real estate market. But this really, in many ways, epitomized both the success of Dubai, but the limitations of the success. The absence of regulations, the absence of a government framework, the absence of any constraints on who comes in, who develops what, at what pace. Basic information such as supply and demand in the real estate market remains sort of in short supply at this very moment. So what is happening in the real estate market was both really the success of Dubai and its vulnerability, and it was only a matter of time before you would see the correction.
Well, let me even ask you a question that came in from our live station chat room right now, going on live from Santosh in Germany, who says, what is the situation of contracted workers? Will they have to take the brunt of the crisis as well? Referring, of course, to the relatively cheap labor that's coming from South Asia, for example.
Well, if developers are going under or developers are starved for cash, as they seem to be right now, a lot of the workers will have to be repatriated back to their home countries. In fact, this is a mixed, sort of a blessing in disguise potentially, although it will come at huge human cost to a lot of the workers. The ability to shift people in and out of the labor market provides Dubai with a flexibility, an adjustment, so to say, to allow it to ride the wave of success and at the same time make the necessary adjustment, the shedding of labor much more easily than other places in the hard times, although this will come at a huge price, cost to a lot of.
Hello and welcome. It seems no one is immune. The world's hottest destination has announced plans for a $20 billion bailout to meet pending financial commitments. For fans of the tiny Gulf Emirate of Dubai, it's merely a correction in what was arguably the world's fastest growing spot. For critics, it's a sign that Dubai overstretched itself and is set for a fall. Well, there's no doubt the Emirate has plenty of appeal. It's famous for having the world's tallest building, lavish properties and headline-hitting development projects such as magnificent man-made islands like the Palm. When oil was above $100 a barrel last summer, it looked as if the region was insulated from the economic storm wreaking havoc over much of the rest of the world. But now many fear that Dubai could turn into a cityscape of half-finished buildings. There are now stories of successful professional expats recently let go from their jobs, fleeing the country and leaving their cars at the airport car parks. As for the army of imported labourers who built Dubai, they're stuck when they're laid off because their contractors still hold their passports. So today we ask, could Dubai go from being a symbol of boom times to a symbol of worldwide recession?
Well, I think at the moment we've seen a brief surge in the Dubai stocks again. We've seen a brief restoration of confidence. The $10 billion bond will certainly help Dubai in the short term. It's just a question of whether this model can actually work. I agree to some extent with Tariq Yusuf's earlier comments. Dubai is too big now to fail. It's part of the UAE. We should never forget that. It will be rescued ultimately. But that's a separate question to whether the model itself was actually successful if it had to stand on its own 2 feet. We must bear in mind that the bailout bond we've seen this weekend is allowing Dubai to simply refinance debts for another 5 years at interest rates of 4%. It would have never been able to get that on the international credit market. We saw only a few days ago what a struggle Bourse Dubai had in order to refinance debts of just $3.5 billion for just a further 12-month period. It couldn't really do it. It couldn't get the full amount. It had to go to the international market. And many of the big multinational banks that were on board with Bourse Dubai's debts earlier are now gone and replaced by Indian and Asian banks.
Well, let me put an email question to you, Dr. Davis. This came in from Jordan, from a viewer by the name of Tariq Khotat, who says, it's over. Unfortunately, nothing superficial lasts for